Now, European shares have fallen to their lowest level in more than 20 months. It follows heavy losses on Wall Street yesterday, which led to markets in Asia plunging to a 19-month low. The drop follows IMF warnings on international financial stability. Well, joining me now to discuss all this is our business editor, Sasha Vakalina. Sasha, how are markets in Europe doing right now?
Not that well. What started in the morning, they're actually plunging even more than at the opening of the trading. So basically, we have to say here that what we see now happening in Europe at European stock market is just the reaction, basically, to what has happened to Wall Street, right? There is and the correction and the reaction, this is the same with Asia. It all started, this big sell-off started in the US, not in Europe. But of course, in Europe, markets as well have lots of reasons to worry, right? We have, of course, trade war tensions and worries about that. We have Brexit happening with the summit coming, and we, of course, have Italy in Europe. These are very European reasons, but all in all, this is coming from the US.
So what stocks were actually, well, what sparked this sell-off? What stocks were affected, I should say?
Well, this is going to sound a bit tricky, because actually what happened is that what sparked it is basically the fact that the US economy is doing really well. You might remember that over a couple of months we have been hearing all those news and headlines about Wall Street going higher and higher and record highs and so on. It cannot last forever. First of all, there should be a correction. When it's rising, rising, rising up, it should correct at some moment. But at the same time, what we've been seeing is that the US economy has been doing really, really well in terms of the GDP growth, in terms of the unemployment situation that is very, very low, and of course in terms of inflation. All these factors, that means that the US Federal Reserve, the central bank, thought, okay, if the economy is strong enough, it's time to rise interest rates. And this is something that is really hurting corporate sector and the economy, because the companies in the US and the US businesses have been enjoying almost zero rates for what, over a decade now, since the financial crisis of 2008. They now have to readjust, and high interest rates would probably mean to them that it's going to cost more to borrow for them. That means they would reconsider how they spend that money and how they invest that money. So this is a correction. We have to wait for 2-3 days to see whether there is something bigger in that, apart from this very important factor of correction after such a long growth and zero rates for over a decade.
I see. Well, market watchers often say when America sneezes, Europe catches a cold as well as the rest of the world. What are the chances of that now?
The chances are very high, because basically this is not the situation yet in Europe. The European Central Bank is not considering raising rates that sharp yet, but we'll have to wait for 2-3 days to see the reaction and how they will readjust now in Europe and in Asia.